Good day, ladies and gentlemen, and welcome to your Cantel First Quarter 2021 earnings call. All lines have been placed on a listen-only mode, and the floor will be open for your questions and comments following the presentation. If you should require assistance throughout the conference, please press *0 to reach a live operator. At this time, it is my pleasure to turn the floor over to your host, Matt Mikowski, Vice President of FP&A and Investor Relations. Sir, the floor is yours.
Good morning, everyone. On today's call, we have Chuck Diker, Chairman of the Board, George Fotiades, Chief Executive Officer, Peter Clifford, President and Chief Operating Officer, Seth Yellen, Executive Vice President and Chief Growth Officer, Sean Blakeman, Senior Vice President and Chief Financial Officer, and Brian Capone, Senior Vice President, Corporate Controller, and Chief Accounting Officer. Earlier this morning, the company issued a press release announcing the financial results for the first quarter of fiscal year 2021. In addition, we have posted a supplemental presentation to complement today's call. This presentation, along with reconciliations of non-GAAP references, can be found on Cantel's website in the Investor Relations section under Presentations. Before we begin, I would like to remind everyone that this conference call may contain forward-looking statements. All forward-looking statements involve risks and uncertainties, including without limitation, the risks detailed in the company's filings and reports with the Securities and Exchange Commission. Such statements are only predictions, and actual results may differ materially from those projected. Additional information concerning forward-looking statements is contained in our supplemental presentation and earnings release. The company will also be making references on today's call to non-GAAP financial measures. Reconciliations of these financial measures to the most directly comparable GAAP financial measurements are provided in today's earnings press release. With that said, I'll now turn the call over to George.
Thank you, Matt. Our performance in the first quarter demonstrated the unique nature and relevance of our infection prevention and control offering and the strength of Cantel's operating discipline. Most importantly, we continued our steadfast focus on employee safety, which has yielded uninterrupted service to customers. What's clear from the external data and our own results is that we are outperforming the recovery in procedures. We estimate, based on independent third-party data, that in our first quarter through October 31st, U.S. endoscopy procedures were down about 6 to 8% below a year ago. During the same time, Cantel consumable and chemistry products were flat to up low single digits versus a year ago, depending on the category. Similarly, in dental, while U.S. procedures appear to be down 15 to 20% year over year, our dental business was up nearly 2% organically, reflecting similar outperformance versus the underlying market. We are experiencing more revenue per procedure as a result of our strength in PPE, the uptake in our new products, and the adoption of heightened infection prevention protocols utilizing more of our solutions. Over the last 8 months, we have embedded a disciplined operating focus into the company. At the time of the Hugh Freedy acquisition, we knew we would eventually bring our dental business to a 25% EBITDA margin, given first the traditional margin profile of the legacy Hugh Freedy business, second, the impact of synergies, and third, specific operating improvements in the legacy Crosstex business. But as demonstrated this quarter, this has happened on an accelerated timetable, especially with the quicker recovery in procedures. Here is a key takeaway. This operating discipline is in place across all of our businesses. We are making progress on several other fronts. Peter will talk about our early traction with Cantel 2.0 initiatives. Our new product launches with Scope Buddy Plus, tubing sets, and the Defendo cleaning adapter valve have generated momentum. Hugh Freedy launched a new ergonomic scaler just as their manual scalers have seen renewed preference versus ultrasonic scalers to minimize risk of aerosol production in the dental office. Yesterday, we announced a collaboration with Census Technologies, the innovative leader in surgical instrument and asset management systems. This will be a significant impetus to enhancing and scaling up our track and trace and workflow technology solutions in the endoscopy suite with a premier partner. Sean will speak to how our operating performance and disciplined working capital management is generating strong cash performance. We have accelerated our debt repayments over the past few months. Earlier this month, we paid down our revolver by an additional $50 million, bringing our total debt pay down to $125 million thus far in fiscal 2021, and we expect to continue to pursue this accelerated repayment path in 2021. I know we will be asked what elective procedure volumes and revenue performance looks like in our second quarter. So far, November, the first month of the quarter, performed similar to October in terms of day rate revenue in medical and dental. As we pointed out on our last call, the second quarter does have 4 fewer shipping days than the first quarter. As for the rest of the quarter, it's wait and see. We all see the same headlines. What we do know is that as we exit the winter months and calendar year 2021 unfolds, we are expecting to gradually see 100% recovery in procedures, particularly as vaccination programs gain traction. We also know, regardless of exactly what level procedures are at, that we continue to perform better than procedure levels given our comprehensive offering and the critical nature of the solutions we bring to our customers. Last quarter, we gave guidance on EBITDA margin exiting the year. We said at least 19%. We are updating this guidance to at least 22% EBITDA margin exiting our fourth quarter. Now, given Q1 EBITDA margin of just under 26%, this guidance of at least 22% models in a return to normalized operating expense spending in the upcoming quarters. Our performance this quarter demonstrates the earnings power of our businesses when volumes return to normal levels. The enhanced operating discipline we have deployed, coupled with the strength of our suite of infection prevention and control solutions, and recent traction in our Cantel 2.0 programs, gives us confidence in our ability to sustain these operating levels and continue to build on them in the future. So with that, Sean.
Thanks, George, and good morning, everyone. I'm going to go through our key financial results with brief commentary. Following that, I'd like to provide additional details that give context to the financial results during COVID. Of course, the standard reported financial details are available in the earnings deck for you to follow along, and we can cover any additional questions you may have during the question and answer session. Net sales increased 15.5% year over year in the first quarter 21 versus prior year, and 14.7% on a constant currency basis. M&A accounted for 16.5% of the increase, and the FX impact was 0.8%, both of which were offset by an organic decline of negative 1.8%. This significantly exceeded our Q1 expectations, with procedural volumes and demand for infection prevention products in both medical and dental accelerating throughout the first quarter. The medical segment decreased by negative 2.2% on an organic basis in the quarter. Capital equipment decreased 20%, with recurring revenue increasing 2% in the period versus the prior year. It is important to note that while capital sales declined, we built robust backlog during the quarter, representing strong underlying demand. While underlying endoscopy procedures have returned faster than anticipated, our outperformance in our recurring revenue categories above procedural growth indicate market share gains we are seeing with our differentiated infection prevention offering. The dental segment grew 65.1% on a reported basis, driven by the acquisition of Hugh Freedy, and increased 1.8% on an organic basis, primarily driven by the recovery of dental procedures combined with increased demand for infection prevention products in the dental market, inclusive of PPE and disinfectant chemistries. Overall, we believe these results reflect the power of the combined Hugh Freedy Group portfolio, especially in an environment of increasing sensitivity to infection prevention protocols. Life Sciences declined 7.3% on an organic basis, primarily due to lower portable reverse osmosis machine sales. This decrease was primarily driven by demand in the back half of fiscal year 2020 as customers requested these units during the height of the pandemic. In the dialysis segment, we saw organic growth of 8.3%. Turning to consolidated margins. Our GAAP gross margin increased by 460 basis points to 49.6% versus 45% in our first Q 2020, while non-GAAP gross margins increased by 280 basis points year over year to 50.1%. The expansion was driven by the return of volumes combined with our more disciplined approach in managing manufacturing costs, as well as favorable mix due to the higher sales of consumable products. More importantly, at these volumes, we believe we should sustain gross margin expansion going forward. Moving down to op profit. GAAP op profit increased 249.1% year over year to $50.4 million. On a non-GAAP basis, op profit increased 52% year over year to $64.5 million. Our cost discipline around discretionary spend is ongoing, and we will continue to take a cautious approach with OpEx given the uncertainties surrounding COVID. I expect OpEx to remain relatively flat sequentially in our second quarter, on the lower end of the $85 million to $90 million guided previously, and stabilizing around $90 million to $95 million run rate by Q4 depending on volumes. Moving on to tax rates, the GAAP effective tax rate for the quarter was 28.2% as compared to the prior year rate of 33.8%. This decrease was driven by lower permanent items in the U.S. and favorable geographic income mix. The non-GAAP effective tax rate came in at 25% compared to the prior year rate of 25.9%. This decrease was driven by geographic income mix. As a result, GAAP earnings per share increased 307.1% year over year to 57 cents. Non-GAAP earnings per share increased 38.5% year over year to 90 cents. Finally, adjusted EBITDA came in at $76.3 million, up 48.6% year over year. I will now move on to the key cash flow and balance sheet items. Cash flow from operations for the quarter came in at $62 million, an increase of 594.3% year over year, and we ended the quarter with $258 million in cash. Working capital decreased 9% sequentially to $426.9 million, primarily driven by a decline in cash on hand, which was used to repay some of our revolver. Accounts receivable increased 7%, inventory declined 2%, and accounts payable increased 12%, all on a sequential basis. In addition, CapEx was $5.5 million this quarter, which also decreased sequentially. Gross debt ended the quarter at $1,038.4 million, while net debt was $780.4 million. Our net debt to adjusted EBITDA ratio is 3.93 times. As a reminder, we were able to pay down $75 million of our revolver in September. A key element of our Cantel 2.0 initiatives has been to drive operating and working capital improvements. Our heightened operating discipline, coupled with the full implementation of SAP in the U.S., is driving greater insight into our operating metrics, enabling us to better manage our business. We will continue to drive operating efficiency and expect to continue to pay down additional debt in fiscal year 2021. During the last call, we mentioned our intent to pay down at least $125 million in the fiscal year, Given our stronger than expected performance and cash position through the first quarter, we were able to pay down an incremental $50 million of our revolver in November, bringing our total debt pay down to $125 million, completed 4 months into our fiscal year. With our strong operating cash flows, we anticipate paying down an additional $55 to $75 million of debt during the remainder of the fiscal year. Although we still feel it's prudent to refrain from providing guidance for the full year, I'd like to provide some color on the second quarter. In terms of revenue, it's important to remember that we have 4 less shipping days in our second quarter due to the winter holiday season, which we would expect to impact the medical and dental business to the tune of approximately $3.8 million per day. In addition, due to normal seasonality tied to the dental school business, you should assume there is a $5 million seasonal demand in our dental segment in the first quarter that will not repeat in the second quarter. Finally, given the increase in COVID spread across the globe, we anticipate that procedures will continue to stay in line with the past few months until the pandemic starts to become more controllable. As a reminder, we will be filing our 10-Q by the end of this week. I'll now hand it over to Peter to provide a few operational updates.
Thanks, Sean, and good morning, everyone. I wanted to take the time to share some insight into what we have learned over the past 90 days. These observations have and will continue to impact the actions that we take in near and long term to execute on our strategy. At the forefront of the changes that we see is that healthcare providers have fundamentally changed their IP&C protocols in a permanent way. These new protocols are allowing procedure capacity to safely recover faster than anticipated in most geographies. Our products, services, clinical expertise, education, and training are providing differentiated solutions to enhance patient safety and efficiency of practice for our customers. The procedures we support, often considered elective, are critical to hospital, ASC, and dental suite profitability. And as we head into the winter season, we anticipate that healthcare providers will protect and sustain these procedures differently than what was experienced this past spring. The demand for more IP&C solutions and stronger compliance to existing standards highlights the critical nature of Cantel solutions, which are enabling us to outperform procedure volumes and gain share in our medical and dental segments. Our assessment of procedures during 1Q21 placed dental procedures in the range of 80 to 85% of pre-COVID levels, while medical procedures were approximately 90 to 95% of pre-COVID levels. While this is positive news, we do expect patient safety concerns to be higher over the next several weeks. Regardless of any potential near-term impact due to COVID, we are bullish on what we believe the market environment for our products and solutions will look like in the spring, with or without a COVID vaccine. It is worth noting that through November, our daily order intake rates have continued to outpace sales in both medical and dental. This trend, along with the operating enhancements that we've made over the past 9 months, bolsters our confidence in the future. While there is much to do, we know how to manage what is in our control, including our cost structure, discretionary spending, working capital, debt service, and taking care of our employees during challenging times. Moving to Cantel 2.0 and starting out with our U.S. medical commercial initiatives, in the ASC space, we have launched what we term spring training for 1H21 on schedule. Critical activities that we have focused on in 1Q21 that will continue through 2Q21. All ASC sales reps will complete their basic and advanced training courses on selling the full bag by the end of 2Q21, driving targeted equipment placement program wins across this segment of the market. We are already seeing traction in the market related to these initiatives. To put our 1Q21 efforts into context, through the 4th month, we have already matched our full year 20 pipeline and are outpacing placements. Executing infection prevention efficiency reviews in the ASC clinics, which is key to establishing our brand and value proposition while generating actionable VOC insights and significant positive feedback from an underserved market. Refining our field sales toolkit by improving our value selling calculators, better design programs and promotions, strengthening our clinical education materials, all aimed at crystallizing our value proposition. We are very encouraged by the early feedback from ASC practitioners regarding our ability to effectively capture the value from the solutions that we provide. In addition to the progress made in ASCs, we have concurrently accelerated our plans in the hospital setting with positive results. Some of the key highlights include field reps have all completed their advanced full bag training courses. To remind you, we recently configured our medical sales organization from product specialists to full bag reps to better sell the full Cantel portfolio. Our first U.S. inside sales team is now fully operational and closed their first orders in October. This is an initiative that will take time to develop, but we think is a must-have given the access issues that continue to impact the provider landscape due to COVID. New capital programs have been incredibly successful, doubling our normal backlog to $14 million at the end of 1Q21. Our continued investment in the Key Account Director, or CAD program, has given us a unique advantage given its IP&C educational nature, allowing our teams unprecedented access even as facilities have locked down. To give some perspective on the traction of the CAD program initiatives, we have seen faster than average growth in these accounts with approximately 30% higher organic consumable growth compared to accounts not partnered with a CAD program. Needless to say that our programs in the U.S. are in full swing and progressing nicely. In Europe, we continue to gain traction in our commercial excellence initiatives. In terms of our people, nearly all of our reps have completed their full bag training coursework that has been deployed throughout the U.S. team with a focus on consumables. This training will be bringing them in line with standards we have set for our U.S. team. We have put new processes and programs in place, resulting in early wins this past quarter where we outperformed procedures by double digits in terms of recurring revenue streams. We anticipate that these results will continue to strengthen as our initiatives become standard work over the next couple of quarters. In dental, we have executed on numerous initiatives ahead of schedule that have positively impacted the quarter. Out-the-door sales from distributors to customers remain robust. In most categories, up double digits with PPE and back-to-practice kits leading the way. Clinical education and training has been a unique strategy for our dental segment, providing IP&C guidance along with our core infection prevention portfolio to pull through incremental revenue as clinics get back to more normal operations. In terms of core operations, we have made significant headway in preparation of our SAP go live, which we expect to occur in the spring, further simplifying the business. As I wrap up dental, I want to highlight a significant achievement that was mentioned earlier in the call. We initially released a synergy target when we acquired Hu-Friedy and were clear that it was a number we expected to beat. We are pleased to report that we have already exceeded our year 3 target by accelerating the execution of cost synergies between the legacy businesses. This execution has enabled us to exceed our 2 to 3 year target of approximately 25% plus EBITDAS ahead of schedule. Moving over to R&D, we continue to make traction with our launch of both the Scope Buddy Plus and Defendo cleaning adapter valve, with both franchises gaining share in attractive margin categories. Specifically in Scope Buddy Plus, we penetrated 250 customer accounts in the first quarter, driving approximately $5 million in both capital and consumable revenue. In DCA, we are targeting our largest Olympus Scope customers first and have seen approximately 15% penetration during the first quarter. Finally, I'd like to provide an update on our project to add mask capacity globally. We have received our first 2 mask machines into our Rochester facility and should have them up and running during the month of December. We are expecting to receive our next 2 machines into our Italian facility in December and have them certified and up and running in February. The last 4 machines should be in place by May to June timeframe in Rochester. As I mentioned on the last call, due to government subsidies, we will be able to significantly increase our mask capacity while expending very little in terms of net CapEx. I want to take this time to thank our global employees for their extraordinary efforts this quarter in what has been a challenging backdrop. We have over 2,400 team members who go out into the field and come in every day to produce and support our key products and solutions to enable our customers to continue providing care in a safe environment. It is through this hard work and commitment in a difficult environment that we are able to achieve our mission, and we are grateful for their contributions. I'm now going to hand back to George for closing remarks.
Thanks, Peter. Before we get into questions and answers, I have a short leadership change for your reference. Many of you have come to know Matt Makowski as the face of investor relations for Cantel. Over the past few years, Matt has done an extraordinary job managing both the FP&A function along with investor relations. In keeping with our guiding principles of continuous development for employees, Matt has accepted a segment CFO role within the company and has already begun the process of transitioning his responsibilities. Matt has been instrumental in the development of investor relations within Cantel, and we would like to thank him for his contributions. With that, investor relations will be formally transitioning to Ryan Lada. Ryan was previously the CFO of our medical segment and brings strong internal knowledge of the business and financial acumen to the role. We expect to continue to make introductions over the next few weeks. Please note to contact Ryan for your investor relations inquiries going forward. Let me sum up by saying that the key takeaway for this past quarter is that we are delivering on execution. Execution and continued share gains for our infection prevention control solutions in our markets, and execution with respect to operating discipline and cash management. So, as procedures continue their recovery in 2021, we're confident in the sustainability of our stronger profitability performance. Okay, so with that, we're now ready for questions.
Thank you. Ladies and gentlemen, the floor is now open for questions. If you do have a question, please press star one on your telephone keypad at this time. If you're using a speakerphone, we ask that while posing your question, you pick up your handset to provide the best sound quality. Again, ladies and gentlemen, if you do have a question or comment, please press star one on your telephone keypad at this time. We'll take our first question today from Matthew Michon with KeyBanc. Please go ahead.
Good morning, everyone, and thank you very much for all the information and an outstanding quarter as you kind of progress through all of this. Hey, George, first I just want to get a sense for how should we think about the transition to normalized spending in your business. I'm just trying to understand what's sustainable in the margin profile here and what is going to be changing over the next several quarters.
Sure. I think Sean and I can tag team this question. So look, I think as we pointed out in the remarks, first and foremost, the big change or transition that's occurred over the past several weeks and months is in the dental business. We said at the outset before the pandemic with the Hugh Freedy acquisition that we felt we could get this combined business of Hugh Freedy Crosstex to a 25% EBITDA margin. That's obviously happened on an accelerated basis. Just to remind everybody, the legacy Hugh Freedy business was around a 22% EBITDA margin. Crosstex had been at a 22% EBITDA margin, although in fiscal year 19 it was underperforming, and that's obviously has changed meaningfully in this year. So this combined business has gotten to 25%, but we made extraordinary progress on the synergies, obviously the faster recovery in procedures. So look, it's at 30-something% EBITDA margin in the first quarter. We're saying 25% over time. So obviously the transition in that has to do with the fact that some operating expense will come back. When you look at what we said about the overall EBITDA margin exiting the fourth quarter, I said 22%. We're at EBITDAS, that is. We're at 26% in the first quarter. So we've obviously carefully looked across the remaining quarters as procedures recover, what becomes a more normalized operating expense. And look, one thing I can't make clearer is that we have really spent an awful lot of time embedding a cost discipline and an operating discipline in the company. It's been certainly helped by SAP. We've almost looked at things on a zero-based budgeting basis to understand what it takes to run the business on a sustainable basis. So we're very confident in how we see the rest of the year unfolding, provided the recovery in procedures yielding what I said is our goal at the end of the fourth quarter.
Yeah. The only thing I would add is just, to help out with the numbers, is point back to kind of briefly what I said in the call that, we think OpEx will stay relatively flat, going into this quarter. And then, we're kind of pegging it at $90 to $95 million a quarter by Q4, depending on volume. So again, that's kind of how we get back to the 22% that George referenced.
Okay. Thank you, Sean. And then I wanted to shift over to capital. My sense on capital is if it's being underutilized, they tend to spend less of it. It looks as if the procedures are going to be, under 100% for a period of time. What's driving the backlog of capital? And I think what's interesting is your focus moving to on the ASCs at this point. Are you kind of hitting these ASCs at the exact right time as procedures are maybe moving out of the hospital?
Yeah, I'll take that, Matt. Look, first on the capital piece, I think we've been assertive, let's say, in terms of looking at bundles where we can leverage both our cabinet opportunity along with AERs. So I think that's been quite successful the last 4 or 5 months in both the U.S. and international markets. And then on the ASC front, look, I think we are hitting it at exactly the right time. The VOC has been incredibly strong. We jokingly have called the first half of the year spring training as really the key changes and strategy deployment we put in the fourth quarter. We kind of said all along that the first half of the year was really refining what we deployed at the end of the year in the first half to start putting points on the board in the second half. And so far, as I mentioned in my commentary, we've had a lot of success with our EPP programs. That's, again, the equipment placement programs where we bundle consumables to allow folks with maybe constrained capital budgets to bundle where we get advantageous economics but are able to help customers out. Again, it might have some capital constraints to their budgets. And as mentioned in the commentary, we've through 4 months have got line of sight to really outpace already the full year fiscal 20 capital deployment in 4 months already. So it's off to a strong start is the short answer.
And then last question, I just want to go back to the CADs. I think you said they were the areas where you have the CADs, you're driving 30% higher consumable growth. How do those CADs drive that higher consumable growth? Is it just that high touch relationship and them working with those large customers on infection protocols more closely?
Yeah, I think the key is back to that access that we talked about even during the shutdown periods. We've maintained on that CAD clinician model pretty steady access. So we've been continually getting in front of IDN groups here over the last 5 or 6 months. And as you said, influencing and changing protocols at different parts during the GI suite. And that's been very effective. Again, as we've talked about, the ability to sell tops down as a way to, again, simplify and ease the bottoms up going from those full bag reps now in the field on the hospital side. So we have been measuring pretty fanatically here the last year and a half, really the areas where we're seeing growth, where we have CAD coverage, where we don't. And the data has always been compelling, and hence why we've continued to increase that investment sequentially from fiscal 20 to 21 and going from 10 CADs to 14 this year.
Okay. Hopefully you guys are modeling spring trading after the Yankees and not the Mets. All right. Thanks, guys.
Next question.
We'll take our next question from Larry Keusch with Raymond James. Please go ahead.
Thanks. Good morning, everyone. Couple questions. I guess, George, starting with you, just trying to think through, kind of the progress that you made, which has been significant in this quarter as you've rolled out your sort of new platforms and selling models, et cetera. And clearly, you made the point that your revenue growth was ahead of the procedure recovery. I'm thinking, kind of now post-COVID, what's your latest thoughts on sort of how we just should think about the organic growth for this company with, what you've achieved thus far? What's the right way to kind of start to think about a more normalized organic growth range for the company?
Yeah, I think this will sound familiar, but I think our confidence level, continues to increase. But if you look at the parts, medical, endoscopy, I think things were gaining traction on Cantel 2.0 that we could be at 8+% organic revenue growth. Dental, we think 6% growth, and of course in life sciences we sort of modeled it flat. I think again, COVID has certainly provided a strong impetus to what we offer to the consumers, and has sort of reinforced the importance of the complete bundles that we provide in both places. We've talked about the question about what transpires in customer behavior post-COVID, and I think the changes we're seeing are ones that will become embedded, certainly at the hospital, but even in the ASCs and the dental offices, there will be an expectation on the part of patients that these will continue to be embedded protocols. And importantly, we're spending a lot of time trying to talk about the economy of practice in addition to the IPC efficiency of practice, and that's really the message that we were always taking into dental, and we're now taking into the ASC, so that for the ASC that they continue to be able to regain or where they were in terms of efficiency of practice or their throughput, but now with the protocols that we help them put in place. So I don't know, we feel pretty positive about it. I think we've, as Peter pointed out, some of these Cantel 2.0 programs, we're starting to refine the KPIs so that we can track this progress. It's still early days with respect to that, but what we're seeing so far is giving us a lot more confidence around where we're going to be coming out of it.
Okay, that was great. Two other ones. I guess sort of same sort of question, again, either for George or Sean, on EBITDA margins again, as you start to think out, particularly given your ability to accelerate the Hugh Freeze synergies. Again, I'm sort of thinking past 21 and sort of thinking about more 22 or 23, kind of where do you guys think those EBITDA margins could head? And secondarily, Sean, what given the operating expense numbers that you talked about for the 2Q, and then as you move into the 4Q, that $10 to $15 million that it moves higher from where we are today. What's driving that increase in operating expense? Thanks.
Okay, I'll start with the simple, question about operating expense, and that's primarily, if it's going to be driven incrementally, it's going to be a lot of it's just going to be discretionary spend. It's still at pretty historically low levels around, COVID. We don't anticipate all of that will come back, but we do anticipate that some of it will come back as we're putting out in terms of kind of the informal guidance. A little bit of headcount, would come in to play as well, but that's really not a significant driver of the 21 numbers. It's really more just anticipated discretionary spend coming back. But I would also point out, Larry, that that's also like the lever for us as well in terms of being able to preserve margins going forward. As George's point, we have quite a bit of confidence in our ability to operate even, in good times and turbulence to maintain that. As far as going past, 21, I know this is one of our favorite topics, but yeah, I think it's even relevant answering it in terms of 21 in particular around the gross margin expansion that, we do have a lot of confidence, even net of mix that at these volumes and normalized for those volumes that we are driving meaningful margin expansion with our operating discipline and the culture that we've been driving during the pandemic that we didn't let go to waste. So I think it would be, our target, if you will, informally to continue to try to look at kind of like that approximately 50 basis point expansion year over year going forward in our operating margins.
Yeah, I think we've not spent a lot of time in talking about what happens 2 or 3 years from today yet, but other than sort of understanding our growth rates. But look, we said 22% in the fourth quarter. And I said that's a good starting point for next fiscal year. As we continue to make progress in Europe and build the business in Europe, obviously that helps improve profitability. So I would say beyond fiscal year 21, as we get fiscal year 22, we get into fiscal year 23, we should pick up another 100 basis points or so in that progress. So I think, look, our goal is to ultimately get to 24 to 25%. And obviously this year with what's transpired in the Hugh Freedy acquisition and the synergies and basically a reset in how we look at our operating expense. And also, I should add too, this is an important point. We've done a lot of things that we promised would transpire and yield benefit, like SAP implementation, for example, and some things we've done in rooftop consolidation that are paying benefit now as well. They were obscured, at the outset of the pandemic, obviously with the revenues, but I think those are other things that are starting to improve as well.
Okay, very good. Thanks, guys. Appreciate it.
You're welcome, Larry.
We'll take our next question from Mike Matson with Needham & Company. Please go ahead, sir.
Yeah, good morning. Thanks for taking my questions. I guess I just wanted to ask about the ASC setting. So can you maybe talk about the biggest opportunities there? Is it really around the procedural products? And can you remind us what the penetration of the procedural products is in that setting?
Yeah, I'll help with that, Mike. So look, just from a share or positioning there, just to remind folks, again, we own about 50% of the AER install base in ASCs. And our best view on proxy for sort of, let's call it the valve business on the ASC side, is we think that market's only penetrated about 15%. So look, I think as we've, again, it's early days, 3-4 months in, but I think we are really, really excited about, we see opportunities across the board, whether it's on the capital side of AERs and furthering our share position to, making headway on penetrating the cabinet side of the business, as well as a whole host of other products like Scope Buddy Plus with the tube set consumables on the backside, as well as the valve business, and obviously we see opportunities for our chemistry business as well on the ASC side. So.
Okay, thanks. That's helpful. And then this capacity expansion you're doing for masks, how confident are you that the demand will still be there by the time you get done with that, given the timing around the vaccines being administered kind of hopefully by middle of next year?
Yeah, I think our premise there was, look, the capacity was nearly free, net of the subsidies from the government. So that's the first point is, look, we didn't have to pay a whole lot to get basically in a position to double our mask capacity. We used to have about 190 to 200 million a year of mask capacity, and that's roughly going to double over time. But certainly, look, we think there are protocols that have permanently changed or at least adherence to those protocols that aren't going to go back. And the best example, again, is on the dental side where, look, the protocols have been there that hygienists and dentists should be changing their mask after every patient. And the reality is before COVID, that really wasn't always the case. You might have had a practitioner that changed their mask at lunch and then again at the end of the day. And I think there's been far greater adherence to changing your mask after every patient. and I think that sticks. So as an example, I mean, that's a doubling or tripling of the, requirements on the dental side as we see that being permanent. So we do see opportunities to utilize that capacity on the dental side. And look, I think it also gives us an opportunity to be opportunistic in other markets where we might be able to bundle products together.
Okay, great. Thank you.
We'll take our next question from Larry Solow with CJS Securities. Please go ahead.
Great. Good morning, guys. Thanks for certainly a lot of information. Could we just clarify? So on the clearly, you beat sort of every line item between a little bit higher sales on your pre-announcement, and then certainly much greater gross margin expansion. And it sounds like your targets and your EBITDA exiting the year at 22 versus 19%. Is most of that adjustment related to your confidence in sort of achieving these higher gross margin levels, and then the operating margin and expense level, there's some wiggle room there, and maybe if you don't bring back all those expenses, you'll potentially have some more upside. Is that a fair way to look at it?
Yeah, I would say it is overall. I'd say the major changes are previously we had kind of anticipated that procedural recovery would be somewhere between 90 to 95% by the end of the year, and so we're more bullish that's going to be at 100% by the end of the year. So that's driving some of that confidence in the expansion that we referenced. And yes, absolutely that we're getting more confident in our ability to produce the fruits that we knew that we were planting with all the operational initiatives that we had in place. And again, I think you reiterated it, but that's spot on that there is room in that climb that I referenced in the operating expense model, so that again as volumes fluctuate off of anything that we forecast, right? We do have room to pull those levers to maintain margin.
Yeah, I don't have anything to add to that, except we use the word at least 22%. So just
right.
To give a sense of our confidence.
Yeah, no, absolutely. And how do you gauge or balance, your significant outperformance in revenue or rebound in recovery in revenue versus sort of, obviously a nice recovery in procedures, but not quite to the level that your revenues recovered. Is there some catch up or, like these return to work kits and, maybe perhaps now that providers plan on using extra PPE and stuff, are they perhaps buying even extra, inventory and stuff? How do you sort of gauge that catch up, or is there, maybe not as much as I'm thinking there is?
Larry, this is Peter. One of the things obviously with the dental side is we have a lot of data on out the door by product category, and obviously you can compare that to our purchases from our channel partners. And we've looked at both on I'll call it a calendar year to date 20, and also just during our first quarter of fiscal 21, the amount of inventory change has been negligible. So the reality is, and that's a good news story for us, that there isn't some big restocking going on. That what our channel partners are buying is what's going out the door. And on the medical side as well, I mean, the nuance that you have to remember, especially on the consumable side, is a lot of these hospitals and a lot of the ASCs don't hold a lot of inventory because they don't have a lot of space to hold inventory. So you're talking about a change where maybe somebody's holding a couple of days to maybe holding a week and a half. So the reality is we just don't see that behavior happening within our core markets. And look, I think at the end of the day, we're seeing that dollar per procedure increase as people, again, are just paying more attention to the protocols and the importance behind it.
Right. And you mentioned, I know Europe, expansion or improvement in Europe is part of Cantel 2.0. Are you seeing any, differences today, in the recovery? Forget, the COVID incidence, which seems to be worse in the U.S., but just in terms of the customer behavior and whatnot in the United States versus the rest of the world, are there any, differences as we sort of begin to rebound?
No, I mean, it's been broad-based in the sense of, meaning we've seen examples in every geography where there are certain practitioners that are adhering or in some cases creating new standards. Again, the example is we've seen pockets in Germany, we've seen pockets in the United States and Australia, as an example where we sell 24-hour tube sets, and we've seen some clients actually switch that to single-use tube sets as an example, with just the heightened focus on infection prevention around COVID.
Okay. Just perhaps the last question, just so maybe a little color on you announced this deal with Census and on the trace tracker. Should we view this as sort of an early stage thing that eventually will contribute meaningful revenue, but sort of a slow grind, or how should we sort of look at that?
Hi, Larry. This is Seth. We're really encouraged with the partnership that we announced with Census. We've always viewed track and trace solution as an important additional element to our overall complete circle of protection that ties together the overall nature of the portfolio. And we're very encouraged by the ability to leverage the strength of our partner to help accelerate this offering into the market. Obviously, these are substantial investments that hospital systems need to make, so they're not quick sales and quick wins. But we have a healthy pipeline, and we're encouraged by the interest that we've seen from our customer level demand for this sort of solution. And we look to roll this out with the developed product in the coming quarters, and we anticipate this will be a growth driver for us in fiscal 22 and beyond.
Great. Okay, great. Just lastly, I'd be remiss if I didn't just give a shout out to Matt. He helped me out a lot ramping up. So good luck in your new role. And that's it. I'm all set. Thanks, guys.
Yeah, that's not going to influence his pay. So.
Thank you.
We'll take our next question from Mitra Ramgopal with Sidoti. Please go ahead.
Yes, hi. Good morning. Thanks for taking the questions. Just first wanted to start on Hu-Friedy. Obviously, you're well ahead in terms of your targets on the cost synergy side. I was just curious as it relates to on cross-selling front, if you're generating the incremental revenue there that you had anticipated, or if you're already ahead on that front also.
Yeah, Mitra, this is Peter. Yeah, I mean, look, the back to practice, procedural kits on the dental side that we've been bundling a fair amount of Hu-Friedy with Crosstex as those dental offices reopen. So that's been a pretty big win. But candidly, the growth drivers are still the same. Yeah, the IMS setups are progressing, although new build facilities have obviously slowed with COVID. But those compliance bundles, the Harmony Scaler we just launched in the month of October, so we got minimal sales in October, but we're excited about what that brings the rest of the year. Obviously, the surface disinfectants along with PPE has been huge, and then we continue to lean into Greenlight as a key sterility assurance vehicle to move the whole business forward.
Okay, no, that's great. Thanks. And as it relates to the face masks, face shields, et cetera, I was wondering if you have any restrictions given the federal subsidies in terms of being able to sell more outside of the U.S.
No, there's minimalist handcuffs on that. We just need to keep the capital actually in the United States is pretty much the main requirement on the machines on the foreign machines that we got assistance from the U.S. government on. And it's a similar profile on the two machines that we got in Italy. We need to maintain the capital there, but we can manufacture and export as much product as we need to.
Okay, no, that's great. And as it relates, I believe you mentioned, we should be expecting some incremental headcount coming on as you go to business. Where do you stand on the sales force front, especially given the push or increasing push into ASCs and just building up the business going forward?
Yeah, I mean, even during the shutdown here, we protected the investment on the sales side, especially on the medical piece. So we are staffed now. I think we'd mentioned in the opening remarks, we're down basically. There's one open position on the inside sales, but we got that up and running in the first quarter. That team got their first orders in the month of October. We're fully staffed on the ASC side in the 8 markets that we targeted. and we've made really strong progress in getting everybody that was put into a full bag role trained, sort of graduating, from getting their masters in selling both capital and procedural products here. So we feel really good that we're positioned as we hit the back half of the year, that we've got not only a highly motivated sales team, but no open positions, and everybody again trained and ready to roll.
Okay, thanks. And then finally, on life sciences, a little later than I was looking for. What's your best sense in terms of when you expect that to sort of flatten out?
Look, it's fairly flat sequentially from 4Q to 1Q, and I would look at the next 2 quarters and probably say revenue is going to look pretty close to the first quarter in terms of sort of trading sideways from a revenue perspective. We've seen the backlog kind of stabilize and level off. This is usually the slowest time of the year, November and December, from an order intake perspective on centrals. As you can imagine, there's not lots of folks wanting to go do new builds in the middle of the winter. So for us, usually the order intake machine starts to accelerate late January, and that's kind of how we see the market is orders that we take in February and March, because of the lead time, we're not going to ship until the late spring or early summer, and so that's probably how I would think about sort of the revenue trajectory.
Okay, thanks. And then finally, just one housekeeping question, I believe, on the interest expense line. I think there was an item that was included in there, some non-cash interest expense. I was just wondering what that amount was, if you had it.
A little less than, I think, about, $1.8 million or so, and that's related to the accounting for the convertibles. It's a non-cash item, to your point.
Okay, perfect. Thanks again for taking the questions.
We'll take our next question from Michael Cherney with Bank of America. Please go ahead.
Thanks so much. One just quick clarification, Sean. You mentioned you expected gross margin expansion to continue. Just want to know, is that off of the 1Q levels, or is this based off of last year and expecting year-over-year gross margin expansion?
It would be in reference, and the best quarter, again, would be our second quarter of 20, looking at us as a whole, with Q3, in fully. So it would be reference to that. I mean, obviously, Q1 itself, there is a little bit of mix help, in terms of the capital versus consumables mix that, will alter going forward. But, relative to those volumes and mix, we do expect a margin expansion year over year.
Mike, we refer to our fiscal year 20 second quarter because it was the last pre-COVID quarter.
That rate, to be clear, was like 47.1.
Yeah, it was 47.1. So, again, if you want to think about, in general, we'd be targeting around 50 basis points expansion on top of that, maybe a little bit better. That would be a good way to think about it.
Okay, that's a very helpful clarification. And then I guess maybe to pull on the mask question and the PPE dynamic and infection prevention you're doing within the dental markets, as dentists continue to think about reformatting their workflows, you gave some color around how much they're going to switch out masks. How much are they coming to you in terms of having that strategic discussion to make sure that they're appropriately sourced, especially at a time where there are some other mask manufacturers that have high levels of quality, but you're also fighting a battle of third-party, black market, whatever you want to call it, challenges, and how early, whether it's with masks or some of the other PPE, can you get into those conversations to make it more strategic type sales versus some of the rush demand that you're likely still seeing across the market?
Yeah, that's a good question, Michael. I mean, look, we are having those conversations with the larger channel partners. You could think of it as almost getting into a position where ultimately you have dedicated machines and capacity that folks are definitely thinking about how they source strategically differently than they used to. Much of the last 5 to 10 years has been just get the cheapest product. And obviously there's been a sea change on that in terms of people wanting to make sure that they've got multiple sources and ideally multiple sources with capacity in North America, and not getting caught again from an exposure perspective where the entire supply chain that they were buying from was in APAC. So we do think there are opportunities to bundle long-term and enter long-term relationships and commitments on masks and face shields specifically.
And if I could just one more follow-up to that, I apologize if I missed this before. Can you give us a sense of dynamics within that area of pricing that you've seen across your customer base?
Yeah. I mean, ultimately, we only change our pricing once a year, so there isn't, the channel partners obviously are able to change their pricing real time to the market, which I'm sure that they've done. If we've gotten any real benefit, I think I would categorize it as we have pushed our branded mass very heavily. Obviously, the pricing and the margin profile's a bit higher on the branded versus private label. So from our perspective, our main benefit is really insisting or pushing more forcefully here the branded product.
Got it. Thanks so much.
Yep.
And this concludes our question and answer session. George, we'll turn the floor back to you now for final remarks.
All right. Thank you very much for listening and participating today, and we look forward to speaking with you on our second quarter call. Thanks.
Ladies and gentlemen, this does conclude today's teleconference. We thank you for your participation. You may disconnect your lines at this time, and have a great day.